Hi, everyone. Good afternoon. My name is Anthony Thomas. I'm one of the wealth advisors here at Farther on the Focus team, and I'm joined by my associate Raymond Jin, who is also an advisor. We are both fiduciary advisors. Appreciate you joining us today to go over the PG&E retirement plans, focusing on the pension benefits. And without further ado, I'd like to hand it over to my associate. Raymond Jin to go into the topic of today. Raymond?
All right, Anthony. Well, thank you for the warm introduction. As Anthony mentioned, we are financial advisors and we work specifically with PG&E employees to help you all plan and prepare for retirement. I'm a senior wealth advisor at Farther. We work on this focus team where we work specifically with you all to help you plan and prepare for retirement. So for myself, I've been working with PG&E employees for about 10 years now. What that means is I'm very familiar with the pension program, the 401k, as well as the retirement medical plan to help inform you all and educate you on how to make the most out of your benefits. So today we'll be talking about the pension program specifically. And before I go any further, I just want to quickly say that although everything that we'll be talking about today is specific to PG&E, and although everyone on today's call is a PG&E employee, we are not sponsored, endorsed, or affiliated with PG in any way. We're a completely separate financial entity who works specifically with PG&E employees to help you all plan and prepare for retirement. Today I'll be going over an introduction on who Farther is, how we work with you at PG&E. We'll be talking and doing a deep dive on the pension program, the pre-2013 plan and the post-2013 plan. We'll be talking about pension eligibility, what age and service you need to meet the requirements to collect your full pension, some age penalties that may be associated with your pension upon reaching certain ages, the different pension options you have to choose from when it comes to retirement, how to decide which one is the most beneficial for you and your family. And we'll go over one of the advanced strategies on how to make the most out of your pension. So a little bit more about Farther. At Farther, we're a fiduciary advisory firm. So what that means is we have a legal obligation to do what's in your best interests. When you're working with us, you're the client, not Fidelity, not PG&E. So anything and everything that we would ever recommend to you would legally have to be in your best interests. The fiduciary standard is really the golden standard these days. So if you talk to any financial advisor out there, this really should be one of the first questions you ask. Again, are you a fiduciary? At Farther, we take a very focused approach. So again, what that means is we work specifically with PG&E employees, working with you all to make the most out of your 401k plan, out of the pension program, out of the retiree medical, and really help you understand how to walk away with as much money as possible. At Farther, we also take a very comprehensive approach with everything financially related. So in addition to helping with your pension, your 401k, we also provide investment management. So management of your IRAs, your brokerage accounts, any investment accounts that you have. We also provide financial planning, making sure that you're creating a financial plan, creating a roadmap to reach your milestones, to reach your financial aspirations. When it gets closer to retirement, we also will help you put together a financial analysis. So based on the type of lifestyle that you want to maintain in retirement, we want to make sure that you're on track and stay on track to be able to retire on your terms when you want to. We also provide tax planning. If you have questions about why are my taxes so high? What are some ways I can reduce my taxable liability? We can provide you some strategy on just how to do that. Another big one is estate planning, especially here in the state of California. It's very important to have a living trust these days. It allows your family to avoid probate. It's a very messy process. It takes time, takes money. So we can help you put together a living trust to make sure that all your ducks are in a row. Dot all of your I's, cross all of your T's, and as you approach retirement, you have a bulletproof plan. So diving into the PG&E pension program. So depending on when you were hired with the company, you're going to fall under one of two programs. For the folks that are on that were hired before 2013, you're going to be on the plan that's called the final average pay plan. You'll see on the left-hand side that under the pre-2013 plan, there's a 5-year vesting period, What that means is it takes 5 years for you to fully invest into the pension program. Once you invest into the pension program, you are obligated to pension. You know, PG&E has to pay you a pension no matter what. It really depends on how many years you serve at the company. That will determine how much pension you will receive. Under the final average pay plan, the earliest you can collect your pension is going to be 55 years old, and I'll go over this in more details as we get to that slide here. And for everyone that was hired after 2013, you would be on what we call the cash balance plan. Under the cash balance plan, it's going to be a 3-year vesting period. So after 3 years, you are entitled to the pension program. The main difference with the cash balance plan, it is a lot more portable. So instead of the age and service requirements, the cash balance plan is going to be collectible at any age. And under the cash balance plan, you're going to have one additional option called the lump sum rollover option, which allows you to collect your lump sum as a one-time lump sum payment versus receiving as monthly payments for the rest of your life. Another big difference is under the 2013 plan, the cash balance plan is not as generous as the old plan. So what PG&E did to make up for that was they gave you an enhanced 401k match. So if you're on a newer plan, your 401k match is going to be 8% versus on an older plan, your 401k match is going to be 6%. So diving into the final average pay plan. So this is for folks that were hired pre-2013. This is the pension formula, and how it works is they take 1.5% per years of service for the first 25 years of service that you work. If you work beyond 25 years, what they do is they take 1.6% per year, and this is for any year that is after the 25-year mark. They multiply that by your monthly equivalent compensation. So that is based on how much you receive on a monthly basis. And that will produce your single life annuity. This will produce what your monthly pension will look like, minus any age penalties that will be applicable, and that will be your final pension calculation. Actually, one more thing that I want to note here is that for a little trick that we like to teach folks here is because of the monthly equivalent compensation, it takes a look at the previous month of how much you were paid. So for the folks that are on the union side, typically you get a pay raise, January, February of each year. So if you're approaching retirement, one trick that you can utilize is you wait until you get your pay raise, you work 1 month, and after that 1 month of service, you retire. What that does is it allows you to use that new rate as your entire pension calculation. So your entire pension formula and how your pension was calculated for the last 30 years of service will be based on that new rate. Here is a graph that shows how your pension is calculated or how the penalties will be associated to your pension. So on the far right-hand side, you'll see that if you have 30 years of service or more, you are completely penalty free. However, if you have 15 to 29 years, you'll see that the blanks start at 62 years old. So what that means is if you are between these years of service, if you retire before 62 years old, these age penalties will be associated based on what age you are. So for folks that are in that age group, you want to work until at least 62 years old to be completely penalty free. And then for folks that have 15 years or less, this may be for someone that started late with the company, maybe you had a prior career somewhere else, you will have to be at least 65 years old to be completely penalty free. You'll also see on the very last row here that the earliest you can collect your pension is 55 years old. So even if you hit your 30-year mark, let's say you started at the company when you were 20 years old, you have 30 years with the company, yes, you're completely penalty free, but you will not be able to collect your pension until you're 55 years old. This is the pension formula for the folks that are on the management side or on the administrative and technical side. The pension formula is going to be a little bit different. How this works is they take 1.7% per years of service that you served, multiply that by your average compensation over the last 36 months. and that will produce your single life annuity minus any age penalties that will be applicable. One important thing to note here is that if you're on the union side and you're considering moving to the management side in the last couple of years before you retire, the first one is going to be that the 36-month of basic compensation means that you're going to have to work in that position for at least 3 years for you to see the benefit on your pension. There's one more additional category here under the management pension is that you'll see that on the right-hand side, there's an additional column. So, so for the folks on this side, you'll be completely penalty free when you reach 35 years of service or more. So if you're someone that has 30 years of service and you plan to retire within the next couple of years here, it's important to consider that if you want to move to the management side or administrative and technical side, you'll have to make it to that 35-year mark to be completely penalty free. For folks that have 30 to 34 years, the age penalties will fall off at 60. For folks that are between 15 to 29 years, the age penalties will fall off at 62. So for the folks that are on the cash balance plan, the pension formula is going to be a little bit different. They take into account your annual pay credit plus any interest credits, and that will determine what your cash balance will be. So what is your annual pay credit and what does that mean? Pay credits are going to be contingent on your age plus your service. So depending on what your age and your service adds up to, you will get a certain percentage of your pay credited towards your pension. So for example, let's say you're someone that you're 30 years old, you have 10 years of service. For every year that you work, you'll have 6% of your pay that is contributed towards your pension. For let's say someone that is 60 years old and you have 20 years of service, for every year that you work, you will get 10% of your pay contributed towards your pension. Now, in addition to those pay credits, what you also get are interest credits. The interest credits that you get are based on the GAT rate. This is the General Agreement on Tax and Tariffs. And what that means is for every additional year that you work, you'll get a certain interest that is credited towards that pension based on your current pension balance. The rates as of recent has been hovering around 3 to 4%. So you're getting a 3 to 4% interest credit for every year that you work, in addition to the pay credits that you're receiving through PG&E. So here are the payment options. So on the final average pay side, so this is the pre-2013 plan, you have three options. Each one of these options are the monthly option. So you can take it as a single life annuity, you can take it as a joint and survivor annuity. This is typically going to be if you're married, if you have a spouse, if you have some type of survivor that you want to assign your pension to, or you can elect a joint and life will pop up. You'll see under the cash balance plan, there's the same options with an additional option called the lump sum option. Now, a very common question that we get is how do I decide which pension option is the best for me? How do I decide which pension option is the best for myself and my family? When it comes to electing your pension, there's no right or wrong answer to this. It really depends on what's most important to you and your family. So I like to go over some pros and cons to both the lump sum versus annuity. On a monthly annuity side, this is typically for someone that prefers a sense of security. You know that no matter what happens in the market, no matter what happens in the economy, your pension check will continue to come in month after month as long as you're alive. If you select one of the joint options, the pension payments will continue to come in month after month as long as the survivor is alive. So it pays you for 2 lifetimes. However, and that's where the sense of security comes from. However, some of the caveats to the monthly pension is number one, there is no cost of living adjustment. So let's say you get $5,000 when you retire. That's $5,000 in the first year that you retire is not going to necessarily carry the same purchasing power when you're 20, 30 years into retirement. Just think about how much more expensive things have gotten over the last couple of years. Things at the grocery store, gas at the pump, things have gotten tremendously more expensive, and that is because of inflation. Granted, inflation has been high for the last couple of years, but even in normal years, inflation usually hovers around 2 to 3%. That's a healthy inflation rate. So what that means is things just naturally get more expensive by 2 to 3% every single year. Now, with the lump sum, this is going to be for folks that prefer more control over their money. With the lump sum, typically what you would do is you would roll it over into an IRA. This allows you to defer the taxes and not get hit with the taxes all at once. But what the lump sum allows you to do is consolidate it with your 401k into an IRA and invest that money. By investing that money, your money can grow and keep up with inflation. So by keeping with inflation allows you to keep up with the cost of living. So, and another difference with the lump sum is the lump sum, when everything is said and done, anything that's left over, you're able to pass it down to the next generation. Whereas the monthly pension, once you pass away, if you go with the joint and survivor option, once your survivor passes away, the payments stop. So no more beneficiaries to the monthly pension. So one provides a sense of security while the other provides a sense of control. Now, with the pension, what's unique about PG&E's pension is they actually allow you to assign someone other than your spouse as the beneficiary. So you can assign one of your children as your beneficiary. This is one of the advanced strategies that we usually go over, and this is particularly going to be important for folks that may want to assign one of their children as your beneficiary, and particularly for folks that have several children. Let's say you have 3 kids, and under this pension, you can only assign one kid as your survivor. So what you would be doing effectively is giving a lifetime responsibility to that one child to distribute those pension payments between their siblings. They would also have to take on the tax liability for receiving that pension. So what this pension max strategy allows you to do is take that pension money and distribute it more evenly and more effectively across the 3 kids. So what you would do effectively is take the difference between the single life annuity versus the joint life annuity. For example, let's say your single life annuity is $4,000 and the joint life annuity is $3,000. The difference there is $1,000. So that's the spread. What you would do instead is take that spread of $1,000 and use it to fund a life insurance policy. This will allow you to build up a life insurance policy and have a death benefit. And what that does is the death benefit, when everything is said and done, is able to be spread out across the 3 kids. This is a non-taxable event. It allows you to choose multiple beneficiaries. So you can choose more than the 3 kids if you wanted to. If you had another nephew, niece, a church, charitable organization, you can elect them as beneficiaries as well. So what this provides is more flexibility in terms of how you collect your pension and how to distribute it to the next generation. So I'll close off. I want to leave some time for some questions and answers here. So I'll close off with this. The reason why we do these webinars is really to help educate you on how to make the most out of your benefits. What we provide is complimentary consultations where we can sit down with you, do a 401k review with you, review your pension benefits with you. Any questions that you have pertaining to your retirement plans, we can provide you complimentary consultations. What we encourage everyone on this call to do is to construct a plan, especially as you get closer to retirement. Having a retirement plan should serve as a roadmap into retirement based on the type of lifestyle that you want to maintain, based on how much money you need to keep your world spinning. We can tell you exactly how much you need to save up, whether or not you're on track, and whether or not there's any concern about running out of money in retirement. This is also complimentary, so please use this as a resource. We're really here to help you all make the most out of your benefits. And if, let's say, you meet with us, we go over a 401k review with you, we put together a financial plan for you, and you tell us, hey, Ray, this all sounds great. And, I see the benefit in doing this, but I can't possibly do this myself. We're in the business of managing your retirement accounts. And at that point only would we charge our advisory fee. So if you decide that, hey, this all sounds great, I would like to hand it over to you guys to help me manage my accounts. At that point, we will help manage your 401k, your IRA to make sure that you're avoiding any mistakes, and we will charge our advisory fee. So now I'll go ahead and turn it back to Anthony for any questions and answers that we have.
Appreciate
Anthony?
that, Ray. So going through the chat here, folks, we'll answer the questions just in sequential order. So first question that came through here, just want to confirm if hired after 2013, contribution amount match is 8% for 401k. Yes. So as long as you're putting in 8% throughout the whole year, PG&E will match 75 cents on the dollar. So 75% of that 8% contribution per month. There are some caveats to why you would want to use that through the whole year. And if you want to contribute more and you max out early, that's where you would want to talk with myself or Ray, because there's ways to contribute past that 8%, even if you max out and still get the full match. Next question. Hello, I missed the first 5 minutes of this seminar. I'm a represented employee. What is the pension formula, please? Great question. So again, it's going to depend on whether you're a union employee pre-2013 or post-2013. If you're pre-2013, then remember you're on that defined benefit plan. Ray has that formula up on the screen right now. So you'll get the 1.5% for the first 25 years and then 1.6 for each year of service after 25 years. If you're on that new cash balance pension plan, whether you're a union employee or admin and tech, but you were hired after 2013 again, then you're going to get the annual pay credit plus the interest credits gives you your cash balance pension plan. Okay. Next question. How much do I have to gain by moving out of the union if I still intend to retire before 35 years? So just to make sure I'm understanding this correctly, so you want to go from the union side into the administrative or technical side, then really you're going to be pushing out the age penalties if you're not going to work 35 years, right? Because the union side, you only need 30 years or more, regardless of your age, to age out of the penalties completely. So if you only do 30 years and then you say, hey, I'm going to switch to that admin and tech side, then you need to work 5 more years to get out of the penalties. So again, Ray and I could meet with you one-on-one and really dig into your individual situation and give you specific info on, your age plus the years of service. Okay. Next question. For the cash balance pension, do you get the percentage credited only annually or quarterly? It's a great question. I'll answer that first part first. So they're annual pay credits. So you do get that credited annually. If you leave at 10 and a half years, do you get 10 and a half years worth of pension credits, or do you only get 10 years since half a year? Yeah, great question. So they will prorate it for you, if you're leaving, right? But the actual amount will get credited once, on that annual pay credit. Okay. That is different from the interest credits. The interest credits are calculated quarterly and credited to your account on a quarterly basis. Next question. If we are married, can we opt to use anyone else as our beneficiary if we have our spouse's permission? Yes, that is correct. If your spouse signs the waiver, you can name a child or a niece or a nephew as the joint beneficiary. Next question. At the end of the year, always see a big deposit in, not a question, more of a comment here. If I leave before the end of the year, does that end of the year get deposited early? Yeah, so this ties into the earlier question. If you work 10 and a half years and you're on that cash balance pension plan, will they prorate that half a year of service? The answer is yes. Okay. Next question. If I retire early, do I still get my pension? Hired 2014. Yes. So the cash balance pension plan, remember, there's no age penalty, just a 3-year vesting period. So if you were hired in 2014, you would be able to leave in 2017 and actually start your pension immediately because there's no age penalty, right? Next question. I thought under the cash balance plan that vesting eligibility, oh, sorry, the chat updated here. I thought under the cash balance plan that vesting eligibility is the earlier of 55 years or 3 years of service. Is that correct? That's a great question. I've actually never had that one come up. Ray, do you know that one offhand, or is that something maybe I would have to read through
I'm sorry, can
the
you repeat the
benefits
question one more
book?
time?
So the question on the floor is that if you're younger than 55, but you pass the age of 55, but don't hit the 3 years of service, would you still be eligible for the cash balance pension plan?
If you're under 55 years old, but you pass the 3 years of service, would you still be able to collect the cash balance?
So basically, it's an age-based vesting. So let's say you're 54,
Hmm.
right? And you hit age 55, right? And you decide to retire. Would you be eligible for the cash balance pension plan? I've actually never been asked that question. And we may have to look that up to give you the correct information here.
So as long as you reach the 3 years of service, you'll be fully vested in the program. So in this case, you would have to have at least 3 years of service, and at least you have to be at least 55 years old to be able to collect it. So as long as you meet both of those requirements, you'll be able to collect your pension. It may not be a very big pension, but you'll be able to collect it. You'll be entitled to it.
Perfect. Okay. So yeah, no age requirement on that cash balance pension plan. So even if you started at 54 and you don't work the 3 years, you will not get your cash balance pension plan paid out. Okay. Next question. Got a comment there. If you were union pre-2013 and then moved to management, are we automatically moved to the cash balance pension plan? No, so you weren't automatically moved. PG&E sent out a notice and gave you the option to opt into the cash balance pension plan. You had to choose to switch over. Some people did, some people didn't. The best way to check and see if you can't remember is to go into at work for me, run a pension projection for yourself. And if you see both pensions, the defined benefit, that's the pre-2013, and the cash balance, then that means you took the opt out and you are now on that cash balance pension plan. Next question. What is your retirement management fee structure? Good question. We charge a flat 1% fee, prorated monthly for our services. Next question. I will be 65 this year and intend on retiring February 2027. I started at PG&E 9/2019, so I'm assuming that's September 2019. So if I understand correctly, I will have a score of 72, which will be 9% per your chart. How do you calculate the cash value lump sum? So yeah, PG&E makes this very simple, and Ray and I are more than happy to help walk you through the formula as well. But in at work for me, under about me, my retirement, Pension Connect, you can run a pension estimate for yourself, put in those criteria that you just mentioned, and it will give you your pension estimate for that cash balance plan. Last question here. Is being vested mean you cannot lose your pension regardless? Yes, pension benefits are protected federally and insured as well. That's because of the Enron scandal, which I'm sure everyone here is very familiar with, right? So they're federally protected. They cannot take your pension away from you if you're vested. It's a contractual agreement. Now, that's not to say future employees that, PG&E changes the contract with, the unions and their employees for new employees who come in, right? That's how a lot of companies lose their pension. They say, hey, we can't afford to do this benefit anymore. So we're just going to remove it for anyone hired after April 1st, 2026, right? But if you're already in the pension plan, you are legally safe. You will keep that pension benefit. And I don't see any other questions, so we will end it there. Ray and I would like to thank you for your time and attention and great questions. And we will send this out to everyone who attended today as well. Have a great afternoon, everyone. Thank you.
Thank you.